The message flashes across every major news network within the same 10-minute window. A coordinated shutdown notice from port authorities, customs agencies, and shipping alliances on every continent simultaneously, announcing that as of midnight, all international cargo movement, ships, planes, trains, and trucks crossing borders, has been suspended for 7 full days. Meet Marcus, a 38-year-old regional supply chain manager for a mid-sized grocery chain based outside Atlanta, Georgia, who spends his entire career thinking about exactly the kind of network most shoppers never notice. The invisible chain of farmers, factories, ports, and trucks that gets a banana from Ecuador onto a shelf in Georgia in roughly 2 weeks flat. When the announcement hits his phone at 6 in the morning, his first reaction isn't panic. It's a kind of professional dread, because Marcus already knows something most people are about to learn the hard way over the coming week, which is that roughly 90% of everything physically traded across the entire planet moves by sea, and that a single week without that movement doesn't just delay a shipment here and there, it exposes just how tightly the whole system is wound together. He's seen a smaller version of this before. Back in March of 2021, a single container ship called the Ever Given ran aground sideways in the Suez Canal, a waterway that on a normal day handles somewhere around 50 vessels and roughly 12% of all global trade. And even though the blockage lasted only 6 days, shipping analysts estimated it held up close to $10 billion in trade for every single day. It remained stuck, generated freight rate spikes on some routes of nearly 500%, and left more than 400 vessels backed up waiting on both ends of the canal before the jam finally cleared weeks later. That was one canal, blocked by one ship for less than a week. And it still rippled through construction sites, grocery stores, and factory floors on multiple continents. Marcus's scenario is that same shock applied to the entire planet at once. And by mid-morning on day 1, he's already fielding calls from 3 separate category buyers, asking the same question in different words. What do we tell customers when the coffee, the bananas, and the imported cheese stop showing up? The honest answer, the one Marcus gives every one of them, is that nothing about the actual supply of these goods has changed overnight. Farms in Brazil are still growing coffee, and boats in Ecuador are still loaded with bananas. The problem isn't production, it's movement, and that distinction turns out to matter enormously for how the week unfolds. By the end of day 1, factories that depend on imported components start feeling it first, because modern manufacturing runs on a philosophy called just-in-time inventory, a system pioneered decades ago by Toyota that deliberately keeps warehouse stock as low as possible, ordering parts to arrive right before they're needed rather than stockpiling them in advance, which is brilliant for efficiency in normal times and catastrophic the moment the pipeline feeding it stops. Automakers in particular know this pain intimately because the world already ran this experiment once during the pandemic-era semiconductor shortage, when a chip crunch that started with factory shutdowns and a drought in Taiwan ended up costing the global auto industry more than $200 billion in lost revenue in a single year, and wiped out production of somewhere between 9 and 11 million vehicles worldwide, all because a component small enough to hold between 2 fingers simply couldn't move fast enough from the handful of countries that manufacture it to the assembly lines that needed it. Marcus's own company doesn't build cars, but the same logic hits the produce aisle just as hard because a modern grocery store is really just a very fast-moving warehouse with almost no room to spare, most locations holding only a few days of inventory on hand for anything perishable at any given time. Labor is the piece of this puzzle Marcus thinks about least in ordinary times, and most during a week like this one, because every stage of the chain that just froze depends on real people showing up to do specific, often highly specialized jobs. Dock workers trained to operate massive gantry cranes, licensed customs brokers who clear cargo through border paperwork, truck drivers holding the specific certifications needed to haul hazardous or refrigerated freight, and warehouse staff trained on the exact inventory systems a given distribution center runs on. A full stop doesn't just pause cargo, it pauses the rhythm those workers depend on too. And Marcus knows from past disruptions, port labor slowdowns, trucking shortages, and pandemic-era staffing gaps among them, that the workforce side of the recovery often lags behind the physical reopening of ports and borders because idle labor drifts toward other work during a shutdown and takes time to fully return once cargo starts moving again, adding yet another layer of delay on top of the purely physical backlog sitting in the water. Consumer psychology adds a final, harder-to-model variable to the whole picture. Marcus has read enough behavioral research to know that shortages, even mild and temporary ones, tend to trigger buying behavior disproportionate to the actual scale of the disruption. A small dip in available inventory prompting some shoppers to buy extra out of caution, which then creates exactly the kind of artificial shelf gaps that make the disruption look and feel worse than the underlying numbers actually justify. He sees a mild version of this play out by the end of day 2, customers buying 2 or 3 bags of coffee instead of 1, not because they need the extra bags, but because the empty shelf next to the coffee display makes scarcity feel real in a way that a headline never quite does, a psychological amplifier layered right on top of the genuine physical disruption underneath it. On day 2, Marcus watches shelves that normally look completely ordinary start showing visible gaps, not because shoppers are panic buying exactly, but because the restocking trucks that would normally arrive from regional distribution centers stocked with imported goods simply have less to deliver. Coffee, chocolate, bananas, olive oil, imported cheese, and out-of-season produce sourced from the southern hemisphere are the first things to thin out, because unlike domestically grown staples, these products have no local substitute sitting one state away. Electronics retailers a few miles from Marcus's stores start posting the same kind of apologetic signage, explaining that laptop and smartphone restocks are delayed indefinitely, a shortage that traces back to the same underlying vulnerability the chip crisis exposed years earlier, an industry so concentrated that a handful of countries in East Asia manufacture the overwhelming majority of the advanced semiconductors the entire world depends on. Financial markets move even faster than store shelves. Shipping company stock prices swing wildly within hours of the announcement. Oil prices twitch as traders try to price in what happens when tanker movement freezes, even temporarily. And airline and freight executives start issuing investor warnings about the specific dollar amount of revenue they expect to lose, for every day the suspension continues, the same instinct that led insurers during the Suez blockage to publicly estimate the incident could shave measurable percentage points off global trade growth for the entire year. Part of why a shock like this spreads so quickly comes down to how consolidated the shipping industry itself has become. Because container shipping isn't actually run by thousands of independent competitors. It's dominated by a small number of massive alliances that coordinate routes, schedules, and vessel capacity across the entire industry, meaning a disruption affecting the biggest players ripples through the majority of global capacity almost instantly, rather than being absorbed by smaller competitors picking up the slack. Insurance adds another layer of friction to any recovery, because every vessel sitting idle at anchor or rerouted around a closed choke point still accrues real costs: crew wages, fuel burned, drifting or rerouting, lost revenue from cargo that can't be delivered on schedule, and higher premiums insurers charge once a route is classified as elevated risk. Costs that shipping lines absorb in the short term, but that eventually filter into the freight rates. Every importer, including Marcus's own company, pays for months afterward. Analysts who modeled the financial impact of the Suez blockage on a single major carrier's fleet found that even a 6-day disruption produced tens of millions of dollars in losses. Once ship costs, environmental costs, and inventory carrying costs were all added together for just one company, a number that helps explain why Marcus's finance team spends day 3 of the 7-day freeze not worrying about whether goods will eventually move again, but modeling exactly how much more expensive moving them is going to be for the rest of the year. Marcus's brother-in-law, David, owns a small furniture workshop outside Nashville that depends on imported hardwood and metal hardware from overseas suppliers. And by day 3, David is already telling Marcus over the phone that he's had to cut overtime hours and push back 3 separate customer orders, a version of the exact same story quietly repeating itself in small manufacturing shops across the entire country. Construction projects pausing because a specific imported fixture can't arrive, apparel companies delaying launches because fabric shipments are stuck at anchor somewhere off the coast. What makes Marcus's week particularly uncomfortable is that he already knows, professionally, just how exposed certain categories are, because this isn't the first time this exact vulnerability has been studied in detail. The American pharmaceutical supply chain offers maybe the starkest example in the entire economy. The United States imports close to half of its generic drugs, by unit volume, from India alone, but India in turn depends on China for somewhere around 70% of the active pharmaceutical ingredients it needs to actually manufacture those medicines, meaning a huge share of the pills Americans take every day are only nominally made in India. Chemically, they trace straight back to Chinese manufacturing regardless of what country's name ends up on the packaging. For certain specific medicines, the dependence on China is even more direct and extreme, with import data showing roughly 95% of America's ibuprofen supply, over 90% of its hydrocortisone, and around 70% of its acetaminophen tracing back to Chinese manufacturers. A level of concentration that health policy researchers have flagged for years as a genuine national security vulnerability, not just an economic inconvenience. Marcus doesn't work in pharmaceuticals, but he knows that if his hypothetical week stretched even slightly longer than 7 days, hospital pharmacies and pharmacy chains would be the next domino to visibly wobble. And that, unlike bananas, there's no quick domestic substitute for a specific antibiotic manufactured almost nowhere else in the world. Governments move quickly once the scale of the disruption becomes clear, which is exactly what happened in every real-world precedent Marcus can think back to. Emergency coordination bodies start prioritizing critical categories. Medicine, food staples, and energy supplies, already sitting within national borders, get triaged first, while everything else effectively waits its turn. Countries with strong domestic manufacturing bases and diversified agriculture absorb the shock far more comfortably than countries heavily dependent on a narrow list of imported staples, a split that plays out at the level of entire nations the same way it plays out on Marcus's shelves between products with local substitutes and products without them. By day 4, something interesting starts happening that Marcus has actually been expecting, because it's the same adaptive behavior supply chain researchers documented extensively after the pandemic first exposed these exact weaknesses years earlier. Local and regional suppliers see a sudden, unexpected spike in demand as buyers who normally source overseas scramble to find anything comparable produced closer to home. Some manufacturers start redesigning products on the fly to swap out a component that's stuck at sea for one that's available domestically, even if it means a slightly different specification or a higher unit cost. This exact instinct, building in slack and redundancy rather than relying on a single lean global pipeline, is precisely what analysts mean when they describe the broader shift many companies made after the pandemic from a just-in-time inventory philosophy toward what's now commonly called just-in-case inventory, deliberately holding more buffer stock and qualifying more than one supplier for critical components, specifically so that a shock like Marcus's 7-day freeze doesn't bring an entire production line to a complete stop. Surveys of manufacturers conducted in the years since have consistently found that companies with higher exposure to imported inputs increased their inventory buffers significantly and persistently after living through earlier disruptions. Evidence that this isn't just a talking point executives repeat in press releases, it's a measurable, lasting change in how physical goods actually move through the economy now. Consumers adapt too, in smaller and more improvised ways. Marcus notices customers quietly shifting their baskets toward whatever domestic alternative sits next to the empty imported product. Restaurants near his stores start trimming menus down to whatever ingredients they can reliably source that week. And posts start circulating online with tips on repairing an existing appliance or device rather than replacing it, since replacement units for anything built around imported electronics components are suddenly much harder to find. None of this fully offsets the disruption, but it does something almost as important. It buys time, spreading the impact out just enough that the system bends without fully breaking. By day 5, the picture nationally starts splitting cleanly into 2 categories, exactly the split Marcus has read about in industry reports covering years of tariff volatility and geopolitical tension that predate this specific crisis. Businesses that had already diversified their supplier base, sourcing the same component or ingredient from 3 or 4 different countries instead of 1, weathered the week noticeably better than businesses that concentrated their entire supply chain in a single country for the sake of lower cost. This is exactly the dynamic that had already been reshaping corporate strategy for years before Marcus's scenario ever happened, with recent industry surveys showing the overwhelming majority of retail supply chain leaders actively shifting sourcing away from single country dependency and toward layered networks blending domestic production, nearby regional suppliers, and diversified overseas sourcing. A strategic shift accelerated by years of tariff volatility, Red Sea shipping attacks disrupting another major trade choke point, and lingering memories of pandemic-era shortages. Companies that made these moves early aren't immune to Marcus's 7-day freeze. Nothing fully insulates a business from a total halt in global movement, but they have more levers to pull, more alternate suppliers to call, and more buffer inventory sitting in warehouses to lean on while the primary channel is frozen. Marcus spends part of day 5 on a call with the company's logistics director, going over exactly which physical choke points the global system depends on, because understanding those choke points is the fastest way to understand why a shock like this spreads so unevenly. The Suez Canal is only one of several narrow passages the entire planet's shipping network squeezes through, alongside the Panama Canal on the other side of the world and the Strait of Malacca between Indonesia and Malaysia. And in more recent years, a 4th choke point has become just as important to the conversation, the Red Sea corridor leading up to Suez, where a wave of attacks on commercial vessels in the years following the original Ever Given incident forced hundreds of ships to abandon the shortest Asia to Europe route entirely and reroute around the southern tip of Africa instead, adding somewhere between 10 and 14 extra days to a single voyage and pushing freight costs up sharply on top of an already stressed shipping market. Marcus's logistics director points out that this Red Sea disruption, which unfolded gradually over months rather than instantly like a single grounded ship, actually offers a better preview of what a full week-long global freeze would feel like than the original Suez blockage does, because it showed just how much extra time, fuel, and cost the system absorbs the moment even one of its major shortcuts becomes unusable, without the rest of global trade ever technically stopping. Layered on top of physical choke points is a second, less visible kind of concentration risk that worries supply chain planners even more. The fact that huge categories of goods, semiconductors, active pharmaceutical ingredients, rare earth minerals, and specialized electronics components are manufactured in a genuinely small number of factories clustered in just a handful of countries, meaning a disruption doesn't even need to hit a canal or a port to cause damage. It just needs to hit one of those concentrated production hubs directly. This is precisely the vulnerability that has been driving corporate strategy for the past several years, well before Marcus's hypothetical 7-day freeze ever happens. Recent surveys of manufacturers show a large majority now actively pursuing some combination of reshoring, meaning bringing production back to their home country, and nearshoring, meaning shifting it to a geographically closer country instead of a distant one, a shift driven by rising tariffs, persistent geopolitical tension, and the increasingly obvious lesson that a slightly higher unit cost is worth paying if it means a supplier sits days away by truck instead of weeks away by container ship. Consulting firms tracking this shift have found that a meaningful share of manufacturers now cite factors like a more skilled domestic labor pool, additional tariffs on imports from all countries, and government reshoring incentives as reasons to move production closer to home, while separate industry research shows inspection and sourcing activities surging in nearshore manufacturing hubs like Mexico, Morocco, and parts of Eastern Europe as companies deliberately build shorter, more resilient supply chains instead of the longest, cheapest ones available. None of this fully insulates anyone from a scenario as extreme as Marcus's total global freeze, because even a nearshored supplier still has to cross a border somewhere. But it does shrink the distance, the time, and the number of choke points any single shipment has to pass through, which matters enormously when the question isn't whether trade will ever face a disruption again, but how quickly a given business can adapt when it does. Marcus also spends part of that same afternoon thinking about ports themselves, because reopening the gates on day 7 doesn't actually solve the backlog. It just starts the clock on solving it. The country's largest port complex, the twin ports of Los Angeles and Long Beach that together handle roughly a third of all containerized imports entering the United States, offers the clearest real-world preview of what that backlog looks like. Because a surge in demand during the pandemic era, combined with labor shortages and trucking bottlenecks, once left more than 100 container ships anchored offshore waiting for a berth, with congestion at that single port complex alone stretching on for the better part of a year before fully clearing. Marcus's 7-day global freeze would produce a version of that same jam, not at one port, but at nearly every major port simultaneously, each one suddenly facing a week's worth of stalled vessels arriving all at once instead of spread out over their normal daily rhythm, which is exactly why industry veterans like Marcus never expect a crisis like this to end the moment the official restriction lifts. Then, exactly on schedule, the suspension lifts. Ports reopen at midnight on day 7. Cargo ships that spent a week anchored offshore begin moving again, and cargo planes that sat idle on runways start taxiing toward departure. But Marcus knows from watching the much smaller Suez Canal disruption play out years earlier that reopening the gates doesn't mean recovery happens instantly, because a week's worth of global shipping doesn't just vanish, it piles up. Ports that normally process a steady, predictable daily flow of containers suddenly face a wall of backlogged vessels arriving all at once. Exactly the kind of congestion that took weeks to clear after the Ever Given blockage, even though that disruption lasted only 6 days at a single choke point, rather than 7 days across the entire planet. Marcus's own distribution centers spend the following 2 weeks working through a scheduling nightmare, prioritizing which delayed shipments get expedited first and which can wait, while retail shelves gradually refill in waves rather than all at once. And prices on some of the hardest hit imported categories stay elevated for a stretch longer than the crisis itself lasted, simply because supply takes time to catch back up with pent-up demand. Months later, looking back at his notes from that week, Marcus notices the same pattern showing up across nearly every industry he tracks professionally. Companies that live through the disruption don't simply shrug it off and return to their old sourcing habits. They make lasting changes, the same way earlier shocks like the pandemic and the semiconductor shortage produce lasting changes rather than temporary ones. Businesses accelerate plans to diversify suppliers across multiple countries instead of concentrating risk in one. Governments lean harder into incentives for domestic manufacturing of genuinely critical goods, semiconductors, pharmaceuticals, and basic medical supplies, chief among them, and companies across sectors, quietly decide to carry more inventory of essential goods than pure efficiency would otherwise justify, treating that extra buffer stock less like waste and more like insurance. Marcus's own company ends up formalizing something it had only done informally before, requiring every major category buyer to identify at least 2 qualified suppliers in 2 different countries for anything considered essential. A policy that costs a little more in ordinary years, but that Marcus, having lived through the 7-day freeze even hypothetically, considers cheap compared to the alternative. Energy markets deserve their own mention in Marcus's story. Because oil and natural gas move through many of the same physical choke points as everything else, and roughly a fifth of the world's daily oil consumption normally transits the Suez Canal and its connected pipeline corridor alone, meaning a full week without seaborne energy movement would ripple through gas prices and heating costs, well beyond anything visible on a grocery shelf. Analysts who studied the original Suez blockage years earlier were careful to note that a disruption lasting only a matter of days was unlikely to meaningfully move prices at the pump in a country like the United States, since domestic and North American supply could absorb a short gap. But they were equally clear that the calculus changes dramatically the longer a blockage drags on, with sustained disruption eventually working its way into fuel prices the same way it works into everything else. Marcus's 7-day scenario sits right at that edge, long enough for energy traders to start pricing in real risk rather than dismissing it as a brief news cycle. Food security follows a similar but even more visible pattern because while the United States produces the overwhelming majority of its own staple grains, meat and dairy domestically, it still depends heavily on imports for entire categories of food that simply cannot be grown at scale within its own climate. Coffee, cocoa, bananas, and a wide range of out-of-season fruits and vegetables chief among them. Grocery executives Marcus has spoken with at industry conferences over the years describe this as a deliberate trade-off baked into the entire modern food system, prioritizing variety and year-round availability over self-sufficiency, a trade-off that works beautifully until the exact week Marcus is living through, when that variety becomes the first thing to visibly thin out on store shelves, even as domestic staples like bread, milk, and produce grown within the country barely wobble at all. Government coordination during Marcus's scenario mirrors almost exactly what real emergency planning frameworks already call for during any large-scale supply disruption, prioritizing the movement of medicine, food, and energy above all other categories of cargo. The moment restrictions begin easing, a triage system regulators and trade agencies have refined over decades of smaller-scale disruptions. Hurricanes closing regional ports, labor strikes idling specific terminals, and localized choke point incidents like the Suez blockage. What strikes Marcus most, looking back at his notes once the week is fully behind him, is how closely the private sector's own behavior ends up mirroring that same government triage logic without anyone having to mandate it. Businesses instinctively prioritize their most essential, least substitutable imports first, and let lower priority categories wait. Because scarcity has a way of clarifying what actually matters, versus what was simply convenient to source from far away. Reflecting on it afterward, Marcus keeps coming back to the same realization every time he walks a store aisle now, which is that every single product on that shelf, the coffee, the bananas, the electronics, the medicine on the pharmacy counter behind it, represents the tail end of an enormous, mostly invisible relay race involving farmers, factory workers, port operators, ship crews, truck drivers, and warehouse staff spread across dozens of countries. A relay race that runs so smoothly almost all of the time that its existence only becomes obvious the moment it stops. The 7-day halt he lived through, even as a hypothetical exercise, run purely in his head while fielding real phone calls about real empty shelves, taught him the same lesson economists and supply chain researchers have been repeating with increasing urgency for years now, that modern prosperity was never just about a country's ability to produce goods within its own borders. It was always equally about the vast, fragile, and remarkably efficient international network responsible for physically moving those goods to wherever demand happens to be, and that no single nation, no matter how large or advanced its economy, actually stands entirely on its own anymore. Every product on a shelf is a small, quiet piece of evidence that the success of one country's economy has become inseparable from the success of dozens of others. And the surest way to protect against the next disruption, whether it's a single ship stuck sideways in a canal or an entire planet's trade network pausing all at once, isn't hoping it never happens again. It's building enough redundancy into the system now that when it inevitably does happen, the shelves bend a little instead of breaking completely.